We can now look at the other side of the business cycle, the trading account. And this is to do with the activities of the business. So we start off looking at the sales revenue. What money have we got in for the goods and services that we've sold? And the first thing we do is take away from that the costs of the goods sold. So we work out the actual costs of the attributable to producing those sales. Now there are two types of costs. One are the costs of goods sold, the direct costs. The second would be overheads, and we'll come to those later. So if we take the sales revenue and take away the costs of the goods sold, we can come to a gross profit figure, and then take away our expenses, our overheads, the costs of the offices and various other general costs, and we can come to a profit figure before interest and tax. And we'll take away the interest and we'll take away the tax, and we've now got a figure for profit after paying interest and tax. And the last thing we need to do is to pay the dividends back to the shareholder, and we end up with retained profits. And it's the retained profits that is carried back into the business as part of the assets of the business. So there we have the business cycle, and the money continues to circulate around that business, going from money in the business to buying assets, to selling those assets, those goods and services, getting some profit, hopefully some sales revenue and then profits, paying any interest, tax and dividends, and then retaining that profit into the business, and goes round to cycle again. And we can remember that the balance sheet and the trading account look at all those items and keep account of them. So let's have a look at the main learning points of the business cycle. Money circulates around the business. Profits are made when the sales take place. That's the point when we get our money back and a little bit more beside. The business is a separate entity. We expect the finances of the business to be separate from the finances of the individuals who take part. And the business belongs to those who own it, and they are the shareholders. So retained profits belong to the shareholders. And of course, any losses are absorbed by the shareholders too. The main learning points about the balance sheet. The balance sheet shows all the assets of the business and who they belong to. It is the position at a moment in time, usually a year end. So when we have to make up our year-end accounts, we normally draw a balance sheet to provide the information then. Current assets and current liabilities relate to the current year, the next 12 months. So we expect the current assets and the liabilities to be used or paid in the next 12 months. Some long-term liabilities will never actually be paid while the business exists. They remain in the long-term liabilities, but they represent the ownership of the business. And retained profits result from the trading account and appear in the balance sheet. And the learning points from the trading account, it's also called the profit and loss account or the income and expenditure statement. It covers a period of time, normally a year, and not an instant in time. The balance sheet is about an instant in time, what is in the business and who it belongs to. The trading account covers the trading over a period of time. The matching principle applies. In a trading statement, we match the revenue in that period against the costs in that period of getting that revenue. So that's all, folks.